Hey guys, I'm Roger Herring. I'm the Investor's Accountant, and thank you for coming by our YouTube channel. Before you leave today, be sure you hit subscribe and click the bell. That way you won't miss any of our free educational videos. So right now, click subscribe, hit the bell, and a great video is coming your way right now. Hey everyone, I'm Roger Herring. I am the Investor's Accountant, just like my sign says. Welcome to another edition of Ask Roger. So this week, the question comes from a lady that actually came up to me at a networking event a couple of weeks ago. And she said, I've had the same accountant for years and I've always been able to deduct my rental properties, but this year he told me the law had changed and I can't deduct them. I don't understand why. And I said, well, nothing in the law has changed, but let me ask you a question. How do you have your rental properties? How do you hold them? Well, I have an S corporation. Aha! There's the problem. Rentals and S corporations are not the best idea in the world, guys, because to be able to deduct a rental property in an S corp, you have to have personally funded the loss, which means when you go and use leverage and use other people's money, that's not helping you. That's not personally funding. Personally funding a loss in an S corp comes from two places. One, your stockholders' basis or shareholders' basis, and two, your loan basis. Let's talk about basis. Basis is very important, guys, because the IRS is coming down on this. In fact, there are new reporting forms with the new S corp return, and you have to track your basis over on your personal return as well. So, what is basis? First, stockholder or shareholder basis. And what it is money that you have contributed plus earnings minus losses and minus distributions. You add those up, that's the basis that you have in the S corp that is a shareholder basis. Now, that determines how much loss we can deduct, but it also determines how much in distribution we can take out. So if you have $10,000 in basis, you can write off up to $10,000 of losses, or take $10,000 in distributions. But if you have a negative $10,000 in this basis, you can't write anything off against it, and you cannot take any distributions out. Okay? What's the other kind of basis? The other kind of basis is a loan basis. And that's simply loans minus repayments minus what you've used for losses. You see, in an S corp, you can use your loan basis to also write off losses. So if you've put $10,000 in the company as a loan and you don't have any shareholder basis, or your shareholder basis is negative because of accumulated losses, you can take losses up to the amount of your loan basis. So if this is $10,000, you can write off $10,000 in losses. Now, here's a nasty little thing about the loan basis though. Let's say that you've used your loan basis for a number of years and now you've made a bunch of money. So you would put in 100 grand and at the end of the day you had used $95,000 of that for accumulated losses to be able to deduct them over time. Well, this year you made $200,000 and you want to pay that $100,000 back. Well, the $5,000 that you have remaining in your loan basis, no problem, you pay it back. But the other $95,000 you've already gotten a tax benefit off of. So when you pay that back, you're going to have to record what? A capital gain. I know it gets a bit confusing. Basis is always something there. Tune into the next episode of our podcast, and I'm going to go a little bit deeper into this. Until the next time, Roger out.